Welcome to Subramani. I have been resisting making this video for a very long time because I want my audience to be only those who invest in mutual funds, direct equity maybe, but I don't talk much about direct equity except how to invest. I'm not here to give you tips, right? And that's about all. I cover a very small range of assets, but now there is a huge interest in alternatives, right? Everybody wants to invest in alternatives. Whether the person has 2 crores or 20 crores or 200 crores or 800 crores, everybody wants to look at alternate investments. Why this craze for alternate investments, I do not know. And in my definition of alternate investments, I'm including PMS. So PMF, AIF, hedge funds, private equity, private debt, venture capital funding, all these things, real estate, REITs, all these things are part of the alternate investments. Why do people have this craze for alternate investments? Two things have happened. One is easier access. Everybody today has access to all these kind of investments. They have been brought down and thumbed down to a retail level. So retail, I mean, when I say AIF, it's about 1 crore, but 1 crore is also retail, right? It's not really wholesale. So somebody with 1 crore can put money in an AIF. Should somebody with only 1 crore put money in AIF? That's a different answer. But somebody with 25 lakhs or rather 50 lakhs can put money in a PMS. Somebody with 1 crore can put money in an AIF. Should they put it? Should they not put it? We'll discuss that very separately. So some private equity firms, I've added private equity to this. So there is private equity. There is with greater access, there has to be more caution. For example, there is nothing which stops a person from putting 10 lakhs in private equity. The question is whether that person has the capacity to lose 10 lakhs when they put in private equity or venture capital. It's not a regulated market at all. Because it's not a regulated market, now you know the attraction. Fees is also not regulated. So I can ask for managing your money in a private equity and charge you 2% fees. Nobody stops me from charging 2%. And more importantly, worse, you don't know whether I'm acting as a principal or as an agent. I've invested in somebody's company and now I tell you that, look, some more shares are available. Will you want to? I bought it at 106. Now it is available at 120. So you think, okay, it's not too bad, but you don't know whether I'm selling mine to you at 120 or a fresh issue is happening at 120 or somebody else is exiting at 120. You don't know that. Whereas when I tell you that I'm investing in, say, ICICI Discovery Fund, I cannot be acting as the principal. I have to be acting as an agent because I have to, the units will be allotted to you by ICICI Prudential Mutual Fund and not by me. Whereas here I can tell the promoter, please give some shares of yours to him and my shares I'll give it back to you at whatever price, right? So those secret deals are possible. There is very little regulation, and because there is no regulation, there is no fees regulated. So fees you can charge as much as you want, and greater access will need more caution. This is something which people don't understand, and people don't even understand how it is marketed. One person with about 3-4 crores in 3 crores in net worth, in terms of liquid net worth, was going for a meeting by an MNC bank to put money in a PMS of real estate, again being managed by or created by an Indian bank, right? So he was going for that meeting and I was laughing, saying, look at your net worth of 3 crores, you can't afford to put 50 lakhs in a PMS real estate. He did not even understand, but it was a 5-star hotel and he was being called there he went there with 2 of his daughters, both his daughters, his wife. So he was pampered and people told him, wow, great, you have been selected here and all that. So you feel good and you go with your checkbook and you sign a check of 50 lakhs. 7-8 years later, I think he got back some of his money or maybe most of his money at a rate sub savings bank account. So but it took a long time for him to realize that he shouldn't have done it, right? So it's not that you can tell people don't invest, but well, people will invest. You can't stop. I can't stop even my friends and relatives from investing, and I don't try too hard to stop. I tell them it's your problem, you do it. But at least understand the following. One, can you afford to lose the whole bulk? Like if you have 10 crores and you put 50 lakhs, can you afford to lose 50 lakhs, right? So first, that's the downside which you have to be prepared for. What they tell you does not matter, right? Second, understand the time horizon. If it's private equity, your time horizon in your mind should be 10 years. They may say 7 years, but it is also possible that you may get an exit in 5 years. May not happen. Be ready for may not happen. Don't look at the best case scenario and say in 3 years Secure Capital will come and buy your 10 rupee share at 430. May happen, may not happen. Probability of it is not happening is much higher, right? So know your time horizon. Any of these things are for 10 years, so be ready for a 10-year lock-in. Don't invest funds which you will require in less than, if you're 40 years of age, this money could be your retirement money. It can't be for your son's education or daughter's education, right? Understand the fee structure. It's very difficult to understand the fee structure. They'll say, okay, up to 4%, 0, between 4 and 10%, we'll take 1%, about 10%, we'll take 25% of the profits. It's very difficult and complex to understand, but make sure that you understand. If you don't understand, don't invest. It's okay that you don't understand the management fee, performance fee, surrender charges, all this should specifically, you should say, I'm putting 1 lakh of rupees or I'm putting 10 lakhs of rupees. If it becomes so much, how much will I get? When will I get? How much is the lock-in? What is the penalty for withdrawing before the lock-in? All these things you should know. Do your homework, talk to people, find out what it is, what is their history, what have they done. Find out from independent sources, find out from their investors whom you know. If you don't know anybody, stay away, right? Beware of complexity. It can be a very complicated fund, which is when the Nifty goes up so much we will buy, or if Nifty goes down so much we will buy, and Nifty goes up so much we will sell, and all those things. Just because it is mumbo jumbo, it is not going to give you higher return, right? I've met a VC friend who has invested in some 16 companies. One did better than the Sensex, in which they were very actively involved because the promoter died. So these people were involved, they sacked people, they ran the business, etc., right? So not a great thing to do if you're a private equity guy, but he had to do. The second company in which they did well was again where the promoter was one weak promoter, one strong promoter. They helped the weak promoter buy out the strong promoter, and then the company ran well, where these people put a lot of guardrails and safety, and they kept all that internal auditor and concurrent audit and insurance professionals, and they ran it, right? All the other 13 companies underperformed the Sensex. It's not a great advertisement for saying if you have complex assets you will get better returns. You may not get, right? Check the eligibility of whether you are qualified at all. Check whether you are an accredited investor. If you are not, if you don't have that kind of money, if you don't have at least $1 million or $2 million, don't enter all these places, because it may look like a small amount, but the opportunity cost of this over 10 years is huge. To you, 1 crore may look small, but 10 years later, that 1 crore put into maybe the index would be worth, say, 3 crores. If that is true, then the opportunity cost is also very high. So be careful. If you don't understand, stay away, right? Ask about liquidity after 2 years, 3 years, 5 years. Will it be listed? Will there be private transactions happening? Will I be able to sell? If I sell, what will be the tax position? Check out on all that, right? So when I say check your eligibility, I'm not saying check whether you're an accredited investor. That you know, and that you know in the US. In India, it is not there, right? So anybody can go and invest money in an AIF. All you need is to have 1 crore in your kitty. So find out whether you're eligible. To me, eligibility means you have to have a net worth of at least about 20 crores or 15, 17 crores, and you should have 50 lakhs surplus which you want to invest, right? So all those things have to fall in place before you invest. If these things are not falling in place, not investing is also a good option. Don't be under pressure saying, oh, he's been chasing me, he's been calling me twice a day, therefore I must invest. Not true. It's your money. You can choose not to invest also. Not to invest is also a good choice that you can make. So understand that before you say yes or no. Thank you.